Inflation rates, particularly in the US, are still on the rise. Although we already hit the 5% mark, this is not the peak yet. In our view, in late summer, early autumn, we are likely to see rates around 5.5% and 6%. In this environment, although the increase in inflation is still deemed to be temporary, the Fed has taken the first cautious move toward taking away the ultra-loose monetary policy. Now, lots of more steps have to come before we get there. We think that at the Jackson Hole conference, the Fed is providing the verbal basics for moving ahead. And then, as early as November, they may actually put the words into deeds. And the currently 120 billion of purchases per month are likely to be reduced in a gradual way. The ECB, although inflation is going up here as well, is unlikely to follow. We are likely to see an increase in inflation rates during the course of the year, but the 5 or above figures are not likely to be met. In Germany, however, we are likely to see in autumn figures above 4%. In this environment, the ECB is likely to keep its policy in place as they fear that the tightening in the Fed policy will lead to a tightening in financing condition in the euro area as well. Therefore, the removal of the ultra-loose monetary policy is likely to be on the top of the ECB's agenda by the end of the year. In this environment, driven by US developments, we guess that 10-year Treasury bond yields are likely to be around 2% by year-end. And in Europe, the 10-year bond yield is likely to show a black zero at the end of the year.